Hi, my name is Marcy Bergen. I'm the Member Services Coordinator at APSA. Welcome to FCRA Data, the key to unlocking an expanded credit universe. This presentation is a part of APSA's Business Partner Webinar Series, which allows industry experts to share timely educational topics directly with APSA members. For more information about the series or how to become a presenter, feel free to reach out to me following today's webinar. A few housekeeping notes. To ask a question, use the question box on the side of your screen. The slides and recording of today's webinar will be available later today on APSA's website in the Webinar Resource Center. Finally, you'll receive a survey after the webinar is over. Please take a moment to complete it. Your responses help us fine-tune the program so we can target the issues that are important to you. A bit about our presenters. Alpa Lally is responsible for product management related to Experian's core and alternative data assets, which includes credit scoring models and tools. She drives success in product innovation by bridging technology and business' strategy to deliver double-digit revenue growth. Alpa has been quoted in industry-leading publications such as Housing Wire, Authority Magazine, CU Insights, and Yahoo Finance. Our other presenter, David Elmore, has dedicated his career to becoming a subject matter expert in the use and application of Experian data assets across the consumer lifestyle. The last 5 years, David has worked specifically within the automotive industry, focusing on the use of traditional and alternative data assets to optimize clients' marketing, risk management, servicing, and collection strategies, thus enabling them to achieve and maximize their revenue goals along with their increasing dealer satisfaction rates. And now I'll turn it over to you, Alpa. Thank you.
Thank you, Marcy. Appreciate the introduction. Welcome, everyone, and thank you for joining our webinar. We've got a jam-packed session with not only a dive into our data strategy and our assets in our ecosystem, but also a case study, which David will walk us through near the end. So please send in your questions into the chat window. We're happy to address most of those at the end as we get through the presentation. But let's go ahead and get started. Next slide, please. I like starting out with this slide because it's a question that I like to pose to many people. What are you really seeing in this picture? I know most of you are probably seeing a woman doing a handstand. I see that as well. I also see a very fit individual that probably has a tremendous amount of core strength, probably more so than I do. And it's really fascinating that she's able to hold her spot in this Instagram post. But let's hang on to that thought for a second, because as we build out the slide, you can build out the slide, Marcy. What we really see is that she's got a friend also holding up her legs and helping her do the handstand. And what that shows is, as I draw parallels into the credit industry, and I'm very, very much so oversimplifying this, is as we look at consumers, our consistent message at Experian remains: lenders need to have a full 360-degree view to make the right decision for the right products for the consumers. Meaning, on the surface, you need to add as much data as possible to truly understand the full picture. And in this case, we learned very quickly, this Instagram post showed that this individual was conducting a handstand on her own, but we later found out that she was being supported by another individual holding up her legs. So again, stressing on the importance of how and what alternative data could really add to your ecosystem and insights into your consumer. If we could go to the next slide, please. So to share a few industry insights, we are seeing an overall increase in lenders using data other than mainstream credit. And that data is not only used to provide first and second chances, but also to apply risk-based pricing strategies across the board. With this data, we now have the ability to extend credit to beyond a population that was considered conventionally scorable. And there's no doubt the pandemic has certainly accelerated the need for additional data. We do know that most of, probably approximately 20% of the population is probably in some type of forbearance or payment holiday. So So it's all the more important to have this additional data to grab those insights so that you understand what type of situation or behaviors the consumers are actually operating under. But again, I'd stress the point, this alternative data, it adds additional views because it's beneficial not to the consumers themselves by putting them into the right products, but again, the lenders themselves to paint that full 360 view. Now, while the focus of the session is to share the assets that we have today, coupled with a case study, it's important to acknowledge that there is still positive movement in adoption of alternative data, but there's still ample opportunity for adoption of alternative data. And I know at Experian, we actually refer to this alternative data as expanded FCRA data. And when I say expanded FCRA data, that means data that is disputable, displayable, and correctable by the consumer, so therefore it can be used in a regulated decisioning environment. But what we have learned is that many challenges that the lenders face is understanding that data itself, but we do expect these numbers to increase over the period of time as we continue to educate, inform, and also help many of our customers and clients and lenders through the governance process. Because again, this is expanded FCRA data, all data that's just data that's regulated data from our perspective. Can we go to the next slide, please? A key challenge, or better said, a critical focus area for the entire industry that they're looking to solve for also today is financial inclusion. The reality is that there's marginalized communities that need better access to credit. We know from studies that consumers with lower scores may have access to credit, but will spend probably over $100,000 in their lifetime because of the products they were delivered were not tailored to what they really was exhibiting from a behavior standpoint. But this is the power of our data, coupled with our analytics and technology that can not only drive insights into your traditional thick file consumer, but also insights into your thin file consumers, but also help once consumers that were considered credit invisibles and help them become credit visible. The unfortunate truth that we all have to deal with is that credit invisible or unscorable consumers are likely to have been underserved by the mainstream credit ecosystem. In assessing that risk, past behaviors, no news to anyone on this call, are typically used to predict future repayment behavior. Consumers that don't have a borrowing history on mainstream credit products like mortgage, home equity, auto, credit cards, they're not visible in that traditional credit file. Consumers may be visible if they have limited information, which may make them unscorable, but conventional credit scores that rely on mainstream credit product insights require a significant amount of history to produce a score. More progressive scores, such as Vantage, or custom scores by financial institutions, they use advanced analytic techniques and or require less history to generate a score, allowing more consumers to be evaluated on the basis of, again, mainstream credit histories alone. But it's not enough just to produce a score. Many models simply produce a very low score if there's just not enough history. These credit invisible / unscorable, low score populations that have been underserved by the mainstream credit system are disproportionately Black, Latino, low income, and young adults. Some populations that even have widowed, recently divorced, recent immigrants may also have difficulty accessing the mainstream credit system because, again, they also don't have enough established credit history on their own or in this country. I'm actually an example of an immigrant that came from Canada that had to build credit history. None of that transferred over from Canada. I went through a significant life event like a divorce. At that time, I didn't realize that authorized user behavior does not build credit history. And so a great example of there's a segment of that population that we can truly help, right? But many of these consumers are underserved consumers, may look at non-bank financial institutions alternatives to meet their needs. So beyond being locked out of mainstream credit because of the lack of the payment history, some underserved consumers also psychologically feel they're locked out of traditional credit. And the reality is there's evidence that suggests that when more and more mainstream or lower price options are available, underserved consumers still may actually work with a non-bank alternative. As a result, we believe that lenders must more proactively target these underserved consumer segments with mainstream credit products to help close that gap. So the key challenge to all of this is to source expanded FCRA data. It has a track record of meeting other types of financial obligations across millions of consumers, and they're readily available for all the lenders out there to include in the processes across the life cycle. Delivering more affordable access to consumers, especially that underserved community, it requires incorporating these expanded histories into the evaluation process to make a better or more informed decision, right? Lenders that do not really use these expanded sources are actually excluding viable data that can be used to predict future behaviors on these millions of consumers that are underserved. And I'll go into in a couple slides the different data assets that we have in our ecosystem. If we can move to the next slide, please. Our expanded data assets can be leveraged, as I mentioned a couple seconds ago, across the credit lifecycle. But lenders can really lead the charge by adopting more inclusive lending practices. With expanded FCRA and modern modeling solutions that are readily available today, it can be integrated into your current lending practices. Millions of consumers that are locked out can now be approved for products, and that may help them buy a car or a home. And we have a history of developing these innovative solutions that will drive greater financial inclusion and actively working with lenders such as yourself, regulators, to advance our financial inclusion efforts. Let's go to the next slide and actually chat about our expanded FCRA data assets. So I'll start with our story with our traditional credit data. So today on our core credit file, we have approximately 220 million consumers. Now this data is made up of your traditional trade line, inquiry, public record data. We've now then since applied a tremendous amount of analytics and technology to the sources itself and have come up in 2001 with our trended data assets. Now what trended data assets are is a look back effectively in a consumer's 24-month history. So today, I may have a credit score that's very similar to my partner here, David, and we look like the exact same consumers, may score about a 750 or even 800 for argument's sake. But if you take a look at trended data, it'll give you a very different picture on my payment history, and it may not have been as great as David's over those past 24 months. So therefore, you can leverage that data to make a better risk-based pricing decision and a better product into the consumer's hand, knowing that their ability to pay or capacity to pay is definitely influenced by the past 24 months. Moving along, in 2009, we acquired Rent Bureau. I'm very pleased to share that we have, since our acquisition, have grown that database to about 25 million records, where some of it now is actually all going into our core credit or traditional credit file, all the positive data migrating over. But a lot of that data is important because, as we are all familiar with, if you don't have a mortgage, you're probably more than likely a renter, and rent being the largest expense, right, or if not your mortgage being the largest expense of your monthly bills, is a significant indicator about your ability to pay, capacity to pay, and obviously influences the amount of disposable income or different credit products that you're off. So very pleased to share that this has been growing tremendously over the past few years. We're seeing a massive uptick in property management companies, individual landlords are willing to contribute this data and grow that database as well, because again, they want to see a bigger, better view of the consumer. Moving along, in 2011, we launched our extended view score, our first financial inclusion score back then, which included all of our full file public record data, which included licenses, education requirements, and we've incorporated that into that score. In 2017, just a few years ago, we made an acquisition for our Clarity data assets. Our Clarity data assets are about 60 million consumers on file. The data that's sourced in that are consumers that have gone to online lenders, storefront lenders, using alternative methods to obviously participate in that ecosystem. And as I mentioned, we'll be walking through a case study here in a couple slides. But as part of our data strategy, a critical component of this is also consumer permission data. So with the recent launch of Experian Boost, it allows consumers to be in control of their data. We give consumers the ability to provide access to their banking or their DBA account, where then we can actually go and aggregate information to understand, has this consumer paid their utility, telco, streaming services? That data in a real-time fashion then is incorporated or sent to a traditional credit file and included in their credit report and real-time score. It is a massive movement towards, allowing consumers in general be empowered, right? Allowing them to decide when and where their data can be used. And we see a lot of great momentum and continuing to grow, not just of our Experian Boost product, but other derivatives potentially off of that. Next, in 2020, we partnered with a handful of different property companies, which have now different types of data assets on information about, different homes and whether they're rented, owner occupied, loan to value estimates are all included in those types of data assets. And most recently, we've launched services around our ECBSV service, which is a direct connection into our Social Security Administration to help validation of the Social Security number. We've expanded our remit and our options in the income and employment data. We have a partnership with ADP and have made a number of acquisitions. This year launching Experian Verify, so the ability to verify an individual's income and employment is also a critical step in our ecosystem or any lending decision. And then most recently, and I'll touch on this in a few slides, is our flagship score coming to market, Experian Lift, where it fully leverages the full file public records along with all of our data assets to really drive first and second chances. And now we're venturing into banking data. So we're further expanding our use of DDA account information to draw those additional insights through cash flow attributes, banking attributes in general to really help complete that 360 view of a consumer. And again, all of this data is expanded FCRA data, displayable, disputable, and correctable by the consumer. Let's go to the next slide, please. So a great way to look at this is how that data that we bring to our lenders and reflecting our consumers is really going to drive financial inclusion. So on your far left, we start with conventional scores. So there is approximately, 332 million consumers from the U.S. Census. Of that 332 million, 252 million consumers are what we call credit eligible. Now, your traditional conventional scores require at least one trade line that's been open for the past 6 months and one trade line reported in the past 6 months. Looking at that scoring criteria, you can score approximately 207 million consumers. So 207 of the mainstream credit consumers are scorable. Now, according to a study that the CFPB did, there is about 26 million consumers that are considered credit invisibles or no hits. They have no presence effectively on any of the bureaus out there. But that leaves about 19 million consumers that maybe are dormant, consumers that haven't been leveraging credit or they haven't built enough credit up over time, that are just brand new, maybe, just hitting 18 or 19 years old, getting into that ecosystem. So effectively what we're saying is with conventional scores, it can score about 82% of the US adult population. So that's again off of the 252 million that is credit scorable or credit eligible. Now, if we move to more progressive scores like VantageScore, they have relaxed their criteria and they have come and said, well, we are now able to score some of that 19 million, actually a good majority of that 19 million. They can score 90%, 96% of the conventionally credit unscorables, right? What they've done is they've relaxed that criteria to allow if you have at least one open trade line in the past 24 months or an inquiry in the past 12 months, we can now make you a scorable consumer. So bringing up the population to about 225 million, reflecting about 90% of the US adult population that's now scorable. But here's what the power of all of our data assets actually do. We've come to market with a brand new solution called Experian Lift Premium, where we can now score not only 100% of the mainstream credit invisibles, but also 65% of that 26 million we can now score. And the way we do that is because we've taken all of our data assets and have applied analytics to help score these consumers. That's a pretty phenomenal number, because now we're saying we can, as Experian, score 96% of the US eligible credit population. Now that still leaves a couple million on the side there that are not scorable, but that 7 million that you see there can be brought into the credit ecosystem through some of our other data assets, such as banking attributes. That's another great way to understand what's the consumer experiencing, what are their cash flow looking like, so you can bring them into that ecosystem. We also say there's 2 million of the consumers, though, that are probably not going to ever want to be part of the credit ecosystem. There's no real data footprint of them that exists, right? They're just predominantly cash users, or maybe have some mistrust of the credit ecosystem, but that's a smaller percentage. The highlight here is, again, 96% of the US population the US adults of the credit eligible populations are now scorable. Very exciting for Experian itself. So let's move to the next slide, because I just introduced Lift Premium, and I'm super stoked to talk about how this is our flagship score, leveraging all of our traditional and alternative data assets, or expanded FCRA assets, as described earlier. And it's truly designed to provide first and second chances for all consumers who probably, as I've just walked through those numbers, would have probably been otherwise declined by the current decisioning process that exists today. It really helps identify consumers who may not look good on paper, but are actually probably on their way of road to recovery. It provides lenders with an additional layer of delinquency risk protection to help continue to lend with confidence. And it actually drives data-driven decisioning, right? Better analyze your baits for new opportunities and also detect early warning signs. We could go to the next slide, please. So we believe that Lift should be a part of all of your crucial decisioning strategies, from prospecting to collections. You can approve good consumers, use it in a pre-screen to identify the best candidate. You can use it as early warning signs, as I just mentioned, in account review to monitor growing portfolio risk in ways your traditional scores can't. You could even potentially use it for line increases or decreases and be more effective around that. You can provide a second chance, right? You can provide strong origination applicants with that solid background of another approval opportunity to help them, again, as they're on their road to recovery. And it's a great way to assess ability to pay or repay. It can be used also in early stage collections to provide instant triggers to identify when most appropriate and successful time to collect on the debt may be. Go to the next slide. As I shared, Lift combines the history of traditional credit data with enhanced power and breadth of FCRA regulated data to really drive the highest level of performance. It also incorporates machine learning. Now, this is really critical because it's helped us actually lift the predictive performance in some cases from 2 to 10% across the consumer base. That's just phenomenal stats from our perspective. So again, very excited to have shared Lift Premium and our journey so far. On this point, I'll turn it over to my colleague David here to walk us through a case study leveraging Clarity data. David?
Thank you, Alpa. Appreciate it. We could go to the next slide to introduce the use case. What we're going to cover today is a hit rate analysis, and then specifically a use case for the auto industry. So when we say hit rate analysis, what's our methodology behind that? What we're trying to do is identify an overlap and then break that population down and distribute it by risk tier between Clarity's expanded FCRA records and the Experian traditional credit file. So if you look at the illustration there on the right, it really shows, the Clarity database there on the left, matching up with the Clarity expanded FCRA data on the right. And how we do that is we take a snapshot in time in order to mix those two databases and see the coverage. For the purposes of the next couple of slides, the snapshot we took is actually Q4 of 2020, very recent, and we looked at all auto inquiries and newly opened trades reported to the Experian database. So once we get into it, we're going to talk about, obviously, how powerful that Clarity data can be as an extra lens or view of the consumer at the time of application. But there's also some other things we want to look at on the flip side of that, and that is, well, what does it mean when there's a no-hit? We found that a no-hit can actually be very predictive as well on consumers. We like to say there's kind of a couple different lenses you can look at, right? When there's Clarity data there, are you looking for a potential blind spot, right, with that consumer? Are they accessing loans, that may be off the grid and aren't reported traditionally and not performing or performing on them? There's also an inclusion story there, right? Folks that have fallen on hard times or had a life event, but then have been accessing those alternative financial services, meeting their obligations, but their traditional score and credit file hasn't changed or improved because it's only been reported to Clarity. This is where combining the two databases and looking at the Clarity hit rate analysis can really show you a bigger picture. A couple of things we want to touch on is that, when thinking about the Clarity data, it's really matured over the past 4 to 6 years, especially. The number of data furnitures has expanded significantly, and the loans that they're extending have matured, meaning these aren't just payday loans or short-term loans. We've got, many different kinds of rent-to-own loans in there. We're also looking at, online installment loans that range from 6 to 36 months and have monthly payments of $300 to $500. So when thinking about that rings a bell to sound just like an auto payment, right, or a car payment. So with more consumers taking advantage of these loans, we just want to show you the coverage and overlap in these populations. So if we can move to the next slide, please. Okay, starting off, to level set and take a step back, the next two slides, we're going over Q4 2020 and all auto inquiries and trades reported to the Experian database and then the Clarity coverage in them. So when you think about that entire population of inquiries that were reported in Q4 2020, Clarity had a coverage of 51% of those inquiries. Over half of those had some kind of activity at Clarity, meaning that consumer is accessing alternative financial services, and this would be very important information to know at the time of application. On the bottom left there, what we cover is the Vantage score, right? We want to look at, okay, how does the population break down with the hit versus no hit and overall? It probably wouldn't surprise you. This is a more alternative, near prime, subprime activity database that the hits, average Vantage score is 590. The no hits, 707. And then overall, it falls right in the middle as expected at 647. So what does this all mean, right? Okay, we've got 51% coverage. We've got the breakdown of the overall Vantage score. Well, let's take another deep dive and see how we can actually look at this in the population. On the right here, the green line represents the distribution by Vantage score risk tier of all those inquiries coming into the Experian database. So when you think about that, it's really breaking down, okay, what's the inquiry population, who's shopping for cars, and what's the breakdown? Just for reference, we have all of the Vantage score risk tiers noted on the bottom there, and we're going to take a look at a couple in particular. The first one I want to look at here is the near prime segment. And that score range for Vantage is 601 to 660. That represents 20% of all auto inquiries that came in Q4 2020. Okay, so that's a significant population. And what I like to think about the near prime population is that it's usually trending one way or the other, right? When you think about where the near prime population falls, it's the smallest segment of score ranges. And typically, a consumer that's falling in that range right there could be trending upward, could be trending downward. And so finding out extra information at the time of application is very important. And on those 20% of the auto inquiries that are coming in, Clarity has coverage of 63% when we're thinking about that. So obviously the overall 51, when you get to the near prime segment, is 63% coverage. There's more to look at there. Is there an inclusion story, right? Is there, a more severe risk mitigation story? And overall, could you use it to more effectively price the deal, right? Is there a risk-based pricing strategy that could be applied? Moving on to the right, before we come back over to the prime and super prime consumers, looking at the subprime population, which is what I would call the more mainstream Clarity consumer. This probably shouldn't surprise you, right? It's got 78% coverage, right? But what surprises me a little bit here in looking at that is 30% of all the inquiries coming in Q4 2020, right? That's the largest population of incoming auto inquiries, and Clarity has information on 78% of those. To me, there's an inclusion story there. Yes, you're going to be looking at the risk mitigation, given the subprime population, given the use of Clarity data. But to me, there's absolutely an inclusion story there. I'm looking for emerging consumers and also more effectively maybe pricing some deals to capture consumers and give them a chance. Finally, on this slide, I want to flip over to the prime segment because when we look at that, obviously this is not typically what you would think of when you think alternative data, right? The coverage. It's 28% of the overall application volume, which falls in line, and it's still a significant amount, but you've still got 30% coverage from Clarity. So to me here, there's a definite opportunity. Okay, what's my blind spot, right? Is there something I'm not seeing or I don't know about this consumer at the time of the application, given that they're a prime consumer when they're accessing these alternative financial services? Perhaps it's just them getting more savvy. Alternative financial services are getting more mainstream. Perhaps they're accessing it and paying it. But there is an opportunity here for blind spot coverage. So we like to say that by looking at this across the spectrum and breaking it down by risk tier, there's a lot to see here and an extra lens to look at for those blind spot inclusion and risk-based pricing strategy stories. Can we go to the next slide, please? As we move on, at the same time period, what we did is we took all the new open auto trades, to correct myself, at that time. And on those, it's a little bit lower than the inquiry hit rate, which you would expect. Not all inquiries turn into trades, but when you look at the overall coverage still, it's at 29%. So these are loans that were made. And so when I think about what could have happened here, okay, what wasn't seen at the time of application that could have altered the pricing strategy, inclusion strategy, or blind spot protection? As we look at the bottom left here, probably shouldn't surprise you that the overall population has a little bit higher score range for the trades, right? The folks that actually got a car and got into a loan. The hits, though, are still an average of 635 Vantage score, right? So again, we're moved into that near prime segment for the average score of a Clarity hit. The no hits, 744, and then of course the overall falls, somewhat in the middle at 712. So as we get over to the right here, there's a couple things that I want to jump into. I'm not going to go to near prime first on this one. Where I'm going to start here is the prime segment. Largest segment overall, 39% of the loans that were distributed or reported to Experian in Q4 2020 are in the prime segment. But still, in that segment, almost 1 in 4, 24% had some kind of Clarity coverage. What was going on at the time of application with their alternative financial services usage or inquiries that could have possibly affected the loan that was extended to all those prime consumers? Moving on to the near prime and subprime, this time we're going to go in order. They are 15 and 12% respectively in each category of the total loans distributed. Makes sense. 30% is over in super prime. Obviously, there's not much coverage there. We're not going to concentrate on that for the rest of this segment. When I think about the near prime and subprime, there's an inclusion story there, and there's also some serious risk-based pricing strategy applicability that could be there, because you're looking at the standard hit rates there of 56% and 72% for those two score bands, and obviously just a large opportunity to see more in what potentially wasn't seen at the time of application. So when looking at this, the hit rate is smaller because it's trades, and obviously less loans were extended than inquiries, but the story holds true. Clarity's coverage and the maturity of the alternative financial services market and folks that are using it and accessing it is really basically all over the auto industry and the folks attempting to apply and acquire and get new trades in car loans. Let's move on to the next slide, please. So thinking about overall, what's going on with this population and how can we use this data? How can we garner learnings from this to see how it would affect our population? So for the next 3 slides, we're going to take a little bit of a step back and a different look from the Experian database. We're actually going to take all the new auto trades that were opened in Q4 of 2019, and then we're going to be fast forwarding to using their performance measure of in December of 2020, And that performance measure is the potential to go 90 days past due in the first 12 months. So looking at this, it's still all auto trades, but backed up a year and then given 1 year's worth of performance on 90 days past due. As you can see overall there, before we break it down by risk tier, there's a 394% chance more likely to go 90 days past due if you have a presence of clarity data. If you have a hit in alternative financial services and you're accessing them, you're 6.1% more likely to go, or 6.1% of those are more likely to go 90 days past due as compared to 1.2% of the no hits. It's almost 5 times more likely to go 90 days past due in the first 12 months. And as you can see, as we go along the different score bands there, it rank orders very well, right? When you're looking at the prime, it's just over double. The near prime, it's about 60% higher. And in subprime, almost 50%, and so on and so forth as you go along. In the purple there is the alt finance, presence of data, meaning a hit at clarity is going to be a higher likelihood to go 90 days past due in the first 12 months. So as you can see here, there's this is what we would call definitely our blind spot protection, right? What am I missing? What's the likelihood of this consumer to go 90 days past due in the first 12 months should they have presence of clarity data? Move forward to the next slide, please. What we did here is we took the original statistics from the slide before, that 394% more likely to go past due in auto on the far left, and then we wanted to include all the other industries that we looked at from an Experian perspective. This isn't just singular to one industry. Presence of clarity data can show the likelihood of 90 days past due across all industries. When you look at bank card, it's still there at 293%. Credit union and credit union auto, we broke those two out, 250 and 233%. You've got credit union personal loans in there. We even included a section for fintech, which is 49% more likely. You've of course got home equity and mortgage, and then we get over to retail, personal, and student loans. And of course, while the numbers change, the stability of clarity data and the presence of it showing the likelihood to go more than 90 days past due in the first 12 months is there across the board. And so when we think about this, of course, we're going to concentrate on auto today, but as you look at it across the board, the data and the presence of it, the maturity of the industry shows that it's predictive across all industries. Move forward to the next slide, please. Finally, what we did here is we wanted to show where there are opportunities, right? We talked about that risk-based pricing strategy perspective, the potential for inclusion and the potential for, potential like blind spot protection. So what we did here is, it's a pretty busy slide. So I'm going to go from left to right. On the left here is the Vantage Score risk tier bands, right? And just as we've shown the entire time, we broke those down from super prime all the way down to deep subprime. And then just to the right of that, as a benchmark, we have the U.S. average bad rate on auto loans. So we're going to use that left side there, the Vantage Score and the bad rate as our benchmark. Across the top is what we call our clear early risk score. Now, this is a score that's blended. It's got both Experian and clarity data in it. However, it only calculates when there's a clarity hit. So therefore, for the purposes of this chart, it's only an apples to apples comparison, meaning only when there's a Vantage Score and clear early risk score or clarity hit present does it calculate. Along the same lines as Vantage Score, the ranges from super prime to deep subprime match exactly. We designed it that way. The score range is 300 to 850, and it breaks down in the same population. So level setting with all that information, what does that mean with all this blue and pink, right? So when we look at the blue, that means that the bad rate for those segments or those pockets of the population is below the U.S. average bad rate. Conversely, in the pink, wherever you see that, the bad rate is above the U.S. average. So when we think about that, okay, where's the opportunities here? When I look at this and I see it, I'm looking at the blue, right? And so the near prime category on the left where Vantage Score is, it has a 2.6% bad rate. If you scroll over to the right, if the clear early risk score falls in the prime score band, the bad rate falls to 1.7%. There's a significant opportunity for inclusion right there, right? The bad rate drops significantly if clear early risk score or clarity data is also calculated along with Vantage Score. Right below that, the Vantage Score range is 500 to 600, and the U.S. average bad rate is 8.8%. Now, if you look at both the prime and near prime segments of the clear early risk score, they fall to 2.8% and 4.3% in the blue there. That's significant opportunity to overlay clarity data and or the clearly risk score and I have an opportunity to swap in or include more consumers based on the clarity data, right? The clarity data is showing us that they're actually better than their traditional score sets. Now, on the flip side of these, if you look at in the pink, the bad rates as opposed to the Vantage score, there's some opportunities for potentially, risk or more effective pricing and even a potential to decline in some cases. Because as you look at the prime bucket there, the U.S. average bad rate's 0.7. So as I go along in the different score bands here, if it's a near prime clear early risk score, this does triple to 2.2%, and then almost goes up, 5x if the clear early risk score is subprime to 5% over on the right there. And then as you go down, near prime is 2.6% U.S. average bad rate, but as you go all the way over, if the clear early risk score is near prime, 2.9, and subprime 5.4, and the trend holds true for the subprime rate at 8.8%, looking over at the subprime and deep subprime scores at 10 and 17.5. So what we tried to show here is that there's opportunities across the board by looking at clarity data to both include, cover your blind spot, and really more effectively, price the consumers as they come in by looking at an extra lens of clarity data. So overall, this is what I would call, kind of a swap in, swap out, or dual score matrix. We try to do these with our customers that look at this data to really show the entire story and make sure you're getting, the full picture of your consumer. Next slide, please. And at this point, I will turn it over to my colleague, Alpa Lally, to close this out.
Thank you, David. Great case study. I see a lot of definite benefit and how you can really drive more inclusion and capture more consumers. Thank you for that. So a couple key takeaways as we close out the session, and then we can open it up for Q&A. As we've shared, FCRA data is being used, right, by different lenders across the board. There is a tremendous amount of value in understanding a consumer's full 360-degree view, but more importantly, how do you drive financial inclusion? Our data and our solutions can do that for you. As I've mentioned, it can gain deeper insights, right? That's what we ultimately want to do. We mentioned at the top of the hour that the consumers are still in forbearances and payment holidays. The CARES Act has not expired, right? This is a great opportunity to leverage some of the other data assets to drive that deeper insight and view of the consumer. And alternative data, lastly, is supplemental. It's just essential. It is the new wave. We're seeing a massive increase in adoption. There are some challenges, but nothing we can't overcome together. So I appreciate everyone joining in today to listen into our session. We'll pause here and see if there's any questions that we can address and answer for you.
Hey, thank you so much, Alpa and David. We have a few questions. The first one is, you've shown the impact of simply being present on the Clarity database, but what specific Clarity attributes or data elements do you find to be the most predictive?
That's a great question, and if you don't mind, I'll take that one. When thinking about the Clarity attributes and why they're effective, right, and beyond just having a Clarity hit, it's really all about the frequency and velocity of those data elements coming in, right? Our folks that are applying for different alternative lending services, putting the same cell phone, net monthly income, address, things of that nature on their applications, or are they mixing that data up and really trying to work the system and try to get short-term loans that are risky and have no intent to pay them? So when you think about the different attributes that feed the inquiry attributes, even more so than the trade attributes, are actually more effective in Clarity's database because they're showing that frequency, velocity, and sometimes volatility and lack of stability of that consumer. And that's where they differ a little bit from the Experian or traditional attributes, because those are more looking at the trade history, right? What did they do in the past with their payment history with traditional loans that will tell me the likelihood for them to pay a loan? So really marrying the two together really makes a powerful story, right? Because you've got that trade history and the traditional, but then those attributes that are so unique and are moving so fast and can really tell you the different types of stability of the consumer, using those to overlay or supplement the traditional credit data can give you a better story.
Thank you so much, David. Another question is, can you share what are the barriers to adopting alternative data?
Yeah, sure. I can take that one, David. So some of the barriers, I think it's awareness and education. We've made a lot of great momentum over the past few years, especially after the acquisition of our Clarity data assets, in demonstrating that this asset, it's just data. It sounds very simplistic, but the reality is it's just data. It's regulated data that can be used in a positive manner, right? A lot of our clients, what we're seeing, are using it as swap out opportunities. But as we're seeing this momentum shift and focus towards more financial inclusion, it also represents a chance for swap in, as David has walked us through, like opportunities of, bringing in more additional consumers. I think some of the other challenges around, governance and model governance. And here at Experian, we're happy to help you walk through those conversations with your teams internally to show how you can get through those processes. I think those are some of the biggest barriers. I think from a technology standpoint, yeah, there's going to be hurdles, but nothing in this day and age that can't be overcome. It's a matter of more education, awareness, and model governance from my perspective. But, all things that we can overcome together.
Thank you, Alpa. Another question is, how does the expanded FCRA data address fair lending risk?
Yeah, so all of our data assets, given its expanded FCRA, do comply with the FCRA regulations, and they're all ECOA compliant. And so it follows the same lending practices that we have to have with our traditional core credit data. With solutions like Lift, we actually also supply a fair lending assessment letter, which was actually an independent study conducted by outside counsel, just because we knew these type of questions would start to come up. But, our data is required under the FCRA, follows all the rules and regulations there, and then is also ECOA compliant.
Great, thank you, Alpa. That looks like that is it for the Q&A. So thank you so much to Alpa, David, and Experian. Just remember that the slides and recording of today's webinar will be available on AFSA's website in the Webinar Resource Center. Alpa and David, if you have any concluding statements, feel free.
No, I just want to thank everybody for joining us today. If you don't mind going to the next slide, I think we have a couple of resources that we're happy to share on our diversity and inclusion efforts, right? It's right there, Experian.com. We encourage you all to go take a look at those materials, and feel free to reach out to myself or David. Happy to address any additional questions or have any follow-ups as needed. Thank you again.
Absolutely. Echo everything that Alpa said to conclude, and really appreciate the opportunity to be with you today. Thank you.
Thank you. This concludes today's webinar.